And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis, and Stewart is Managing Partner of Asset Preservation Tax and Retirement Services. Good morning, Stewart. How are you?
Doing great. How are you?
I am doing great, too. It's so nice to see you again.
Yeah, same here.
And things have been so busy for you. I know, because we've talked about just the amount of consultations that you've actually scheduled since the beginning of your show airing. So it's been quite busy for you.
Yeah, we've been absolutely swamped. The show's been great. The response has been phenomenal. So really, really happy right now.
Good. And I'm so happy for you because it's amazing. I love our time together. And I do want to talk a little bit today about the importance of proper planning for when taxes come into play into retirement. Are you finding that a lot of people that come into the office are maybe thinking about certain things, but they're forgetting to plan for taxes?
Yeah, absolutely. So, one major aspect of our company is that we have a year-round tax practice, and what that's enabled us to do is to get a really deep understanding of how investments, Social Security, all of the other sort of taxable events in people's lives affect their tax picture. And what we're seeing is oftentimes people are delaying, or they're putting money into 401ks, for example, but they're putting money into these tax deferred plans, not really understanding the impact later. And so oftentimes, we're all told that, put your money into your 401k, it's going to be, pay taxes later when you're at a lower tax rate. Now, there's a couple of things to consider. After all of these major stimulus bills that have just gone through, $6 trillion originally, and whatever the new one is, it's going to be trillions of dollars, and someone has to pay that back one day. And so from a tax perspective, we are in one of the most efficient tax windows in history right now. So does it really make sense for somebody who's in a 12% tax bracket or 22% tax bracket right now to defer that to later when they possibly will be in a higher tax bracket because they've created these big 401ks, right? They've created these big 401ks to pull it out later to be tax efficient, but they're going to make themselves not only at a higher tax rate later, they're going to make more assets taxable later on. Social Security, for example, oftentimes people, receive $1 million, $1.3 million in Social Security benefits for a married couple over their lifetime. And that does not have to be a taxable income stream in all cases. In some cases, we can, lower it a little bit, but in some cases, we can make that completely tax-free. And so does it make sense to lower your tax bracket now when we're in this just super efficient tax window, or are we going to delay it and pay taxes on Social Security, 401ks, pensions if you have one? I think it's really important to get a true understanding of what your situation is and really, think it through. I just don't think people, I don't think people have done that from a tax planning perspective. And quite honestly, the first decade of my career, I don't think I understood the depth of it. But, now that we have the tax office for the last decade, we've just had a complete awakening to say, whoa, it doesn't make sense, for a teacher that makes, enough money to be at a 12% bracket to defer taxes to win. They could end up doing it virtually, and some people are virtually tax-free because they've got kids in the house. Oftentimes it doesn't make sense to be deferring.
So it's such a benefit that you offer, and not all financial planners have that capability to actually be a one-stop shop, if you will. So the benefit is truly a lot of ease for your clients, right?
Well, yeah, it's absolutely an ease for them. It's not an ease for me because because we've got 700 or so, tax clients that come through our, West Valley office. And, it's incredible amounts of work with all of those people coming through. But what it does for us, once again, it's not about the preparation, right? It's about the planning. It gives us such a deep insight into our clients', tax situation and financial situation that we can do real planning. And the truth is, most big box shops, they aren't even allowed to talk about taxes. What happens when these people are dealing with brokers that don't have a tax office as part of their practice, the financial advisor says, hey, you know what? If you want to talk about the taxes, you need to talk to your tax person. Well, then the tax person says, talk to your financial person. And the reality is the right hand never knows what the left hand's doing.
Good point.
And so that communication just never happens, right? Because you can't talk to your tax person during tax season because they're so busy just trying to stay, afloat here because they're so swamped with all of these clients. Remember, most tax people make most of their money, 80% of their money, within 2.5, 3 months. So these people are working 14-hour days already. The last thing you want them to do is do an analysis of your tax situation during tax season.
Oh, sure.
And that's why we have a separate staff to do the analysis from the preparation.
That's a very smart idea because, like you said, if they're so busy, are they really going to give the quality time? I mean, obviously not. They're going to be like, okay, rushing on to the next thing. So I love that you offer that.
Yeah, there's zombies during tax season. I mean, it's so exhausting. And it is for us as well, which is why we do have a year-round tax practice. It just creates a way more efficient model for our clients. Absolutely. Yeah.
Let me ask you a question, Stewart. So people go through, let's say, changes in their life, whether that be a spouse passes away or perhaps an adult child moves back home. How important is it for them to be in contact with you first when there is a life change, one of your clients, if you will?
Well, it's super important. We send out communications to our clients constantly. The one benefit of COVID, if there is a benefit, is that technology has really changed, and we're embracing Zoom. We have these video emails that we send out to communicate directly to our clients. A lot of messaging, so it's really easy to communicate. So there really is no excuse for, and half of my clients have my cell phone number, and we say, look, call me. I don't care, 24 hours a day. If you call at 2 a.m. in the morning, you're going to get, a funny response from me.
Yeah.
But, when people put their life savings with you, they want to know that you're available, they can communicate. And, it's really important to communicate about any major life changes. Absolutely.
Okay. And how regularly will your clients be hearing from you? Do you send out emails weekly? Do you meet with, is it monthly? What does that look like?
So we do send out informational emails, things for people to, to think about, to stimulate conversation. And we, have kind of those drip systems that do that automatically. But no, we like to meet in person at least once a quarter. And if that in person now is via Zoom because people are uncomfortable with in-person meetings, I get it, and that's fine.
Okay.
Yeah, but communication is everything. There's a lot of shops here that all they're thinking about is marketing and growing their business. And, they talk to you once a year. Generally we try to reach out, at minimum twice a year.
Okay.
And that's why we have a lot of those parties. Like usually we have these huge parties after tax season. We always have a shred it party where everyone comes in, brings all the stuff they need to shred. We have a big shredder truck and we have it catered. It's a great time. But that's not about shredding your stuff. That's about an excuse to mingle with clients. Same with our Christmas party.
Sure.
We do that simply so that we can hang out with our clients. They can say, hey, Stewart, something's going on. It's just two more examples of how we can get in front of clients without setting an official appointment. But, we try to make contact 3 or 4 times a year, absolutely.
Well, Stewart, speaking of appointments, we're going to go ahead and open the phone lines for the very first time this week. Can you tell the viewing audience what they can expect to receive by being one of your callers? Sure.
The first 10 callers will get a free portfolio review where we'll take a look at all of those tax implications we talked about. We can look at, in general, whether or not it makes sense for them to defer, and also take a look at some of the fees that are involved in their portfolio. But for the first 10 callers, we'd love to do that.
Perfect. Thank you, Stewart. To the viewing audience at home, that number to call once again is 833-652-7829. We have to take a very short commercial break, but when we come back, we're going to have more questions and answers for you about planning your perfect retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement knowing that they're not going to run out, that they're going to be fine, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes. It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. And a great show we're having, Stewart. And I wanted to talk to you a little bit because obviously you mentioned Roth IRA conversions, what have you. I have to ask you a question. I've been thinking about this. If it's something that's so beneficial for a lot of people, why aren't a lot of advisors suggesting that to their clients?
Well, it's actually kind of an interesting question here because, people understand with a Roth in general, just to explain this, basically, when you compare a Roth to a regular IRA, an IRA you can take a deduction for immediately. A Roth you cannot. However, all the growth, all of the future, impact of that is tax-free. So anytime you withdraw money from that, it's completely tax invisible when it comes to your other income sources. So it doesn't add to your tax bracket. But your question, it's interesting. Sometimes, there's a couple reasons I would imagine. I think one of them is that I think a lot of advisors don't understand the real impact of what Roth will do, right? The other one is, just think about this. Let's say an advisor has a $100 million book of business that he manages, right? All of the clients together. If he starts saying, you know what, I've got $100 million of IRAs and I know it's better for the client to do this. Oftentimes, understand that the questions that go through their mind as well is that they realize that on that $100 million, if these clients are at a 22% tax bracket, it's no longer $100 million. It may be $78 million. So he just gave himself a 22% pay cut. And so a lot of advisors are under pressure from their bosses, from their managers to produce, to grow their block. So if somebody is shrinking their block of business by 22%, that could be years of their work going down the tubes, whether it's in the client's best interest or not, So oftentimes, that's why it's so important to be with a fiduciary, to make sure that somebody is in it for the client, not just themselves, that all of those implications are taken into consideration. It's really important to think it through. For us, Roth is a great tool. It's not for everybody, because sometimes the concept of Roth, people will pay more taxes converting than the benefit they'll ever receive. Right? But that's why it's important to be able to do a cash flow analysis, of their situation to find out whether it's good for them or not.
Absolutely. And this knowledge can only be gained by coming in to sit with you. I mean, because basically you have so much information to share, and a lot of people in the viewing audience may be thinking about retirement, but they're not sure how to, or how to save money, if you will. So you cover all of that. We have the tax planning option. In the prior weeks, we've talked about the importance of actually saving for long-term care, if you will, healthcare costs. And all of that can be received by just coming in to sit with you.
Absolutely. Yeah, it's really important to just understand whether it will help you or not, right? Once again, people are at the water cooler will jibber jabber and tell their friends, hey, you need to do this or you need to do that. And it's really important to kind of shut off that noise from, the people that are kind of influencing you on the outside. And they may be well intended, But we want to make sure that our clients, when they make a decision, they're making an informed decision as to whether, Roth's a big decision, whether it makes sense or not. And we think it's really important that people can make those decisions with all of the information at their fingertips clearly presented.
Absolutely. Yeah. And you did touch in again about the importance of working with a fiduciary. And so basically what that means to the viewing audience is that you are ethically bound to put their interest above your own. Is that correct?
Absolutely. And we're not allowed to receive fees on any securities transactions directly from the companies. So, for example, if there's a mutual fund out there that's let's call it a growth fund. Well, if a growth fund costs 1% at company A or 0.14% at company B, well, of course, we're going to start looking at the one that's at 0.14% if everything else is equal, because oftentimes brokers will pick the 1% fund because there's a back-end deal with their company. And it's important to understand those fees on the back end. That's why it's really important to do that. And, we have a portfolio analysis that we do that is really in depth. It's really important to understand the fees you're paying, the risk that you're taking, right? Like we have clients that will say, you know what, my broker's been great. He's done really well for me. Well, let's take a look at what the market's done for the last decade, right?
Yeah,
Everyone's made money in the last decade.
Yeah.
The important question to ask is, how much risk did it take to get that reward?
Sure.
So if you're taking 110% of the risk of the market to get 80% of the return, we call that negative alpha. You're taking more risk than the reward that you're receiving. It may not make a lot of sense,
Absolutely.
So you want to understand that risk-reward relationship is in balance there, that it makes sense.
Mm-hmm, absolutely. Are you often surprised when people discover hidden fees in their portfolio that they didn't know about until they came to sit with you?
The reactions, these visceral reactions that people have are just, some of them are incredible. They just get upset. They realize they've been paying these fees forever. Just think about this. If you're, from 2000 to 2012, the S&P 500 was basically flat. It dropped, came back, dropped again in 2008, came back, but it took 12 years to get back to where it was in 2000. That's break even. If you're paying 1% in mutual funds, 1.5%, 2%, whatever in advisory fees, you're at 2%, for example, 2.5% in total cost, which most people don't understand.
Sure.
But let's use the 2% number. If you have $1 million saved and you invest that in January of 2000, by 2012, you have $800,000 because of all of those fees. Just if you're in an S&P 500 fund that has those kind of expenses we're talking about. So they can really dramatically reduce the outcome of your investment strategy.
Sure. And we talked a little bit also about knowing your risk tolerance. Stewart, are you finding that as people become closer to the retirement years, are their risk, is that like a more conservative approach, if you will, to the risk?
Well, I think it's important for people to first know where they're at, right? And I think people are lost when it comes to knowing.
Sure.
And oftentimes when they find out, they realize, oh my goodness, this is just because we do scenarios where we can look back at that same portfolio, we can stress test it, we can overlay what would happen during COVID, 2008, 2000, all of those major events. And the first question I ask when doing an analysis is, how much are you comfortable in losing? And I think that's a conversation most advisors don't have, because they always talk about what they're going to make, not about what you can lose.
Sure.
And I think it's super important. A lot of our portfolios are designed around what we call drawdown, which is how much loss are you willing to take? Some are 7%, 10%, 12, 15, 20, 30, 50, whatever. It's for you to determine your risk tolerance, and then for us to say, we've got this portfolio for you that will accomplish what you're looking to do, and it's at half the current risk of your portfolio.
Okay.
It's really important to isolate what kind of risks people are willing to take.
Absolutely.
Yeah, and the answers to their questions don't usually match what their portfolios say in our analysis. So when they say, look, I'm willing to take 15%. Well, if someone has $1 million account, I'll say, hey, are you willing to lose 50,000? Yeah, I think I can tolerate. 100? 150? No.
Yeah.
Well, that's a 15% drawdown, right? So,
absolutely.
But then we see in their portfolio that it's testing at a 35 or 40% drawdown if 2008 happens again. And that just really doesn't match up with what their stated limits are.
Absolutely. Well, Stewart, we are about ready to open up those phone lines again to the viewing audience at home. Can you tell them what they can expect to receive by being one of your callers today?
Sure.
Okay.
Well, for the first 10 callers, what we'll do is we will offer that complimentary analysis that we just talked about, where we'll take a look at the fees, the risk, the overlap in your portfolio, and that if you just call in at 1-833-652-7829, I'd be glad to do the portfolio analysis for you personally.
Thank you, Stewart. To the viewing audience at home, that number to call once again is 833-652-7829. When we come back after this very short commercial break, we're going to have more questions and answers for Stewart about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, another amazing show, and I can't believe we only have one segment left this week, because every week we're together, they seem to go faster and faster. It's crazy. But I wanted to ask you, because I know a lot of people at home right now are sitting together and they're talking about the show and they're talking about retirement. How important is it to manage your debt as you're approaching the retirement years? What kind of advice can you give the viewing audience on that?
Well, it's funny you say that, because I literally had to have this conversation the other day. It was on Friday that I had to talk with a client about, she wanted to retire, and she's 62 years old. She knows she can get Social Security. She realizes about $48,000 a year after tax, but she's got $50,000 in debt, credit card. So if you've got a full year of debt, if you're a full year of your income that matches your debt, does it really make sense to retire, right? And then 62. People at 62, remember, they oftentimes have to pay for their own health care before Medicare. So it's super important to manage debt. I have clients that will come to me and say, you know what, I need to start saving now. And what I want to do is put money with you because I like you, blah, blah, blah. But I've got, all of this debt. Well, sometimes it makes sense. First of all, get rid of your debt first. If you're
the bad debt.
The bad debt. So if you've got credit cards that are at 22% and you're considering investing now, well, oftentimes it makes sense to first get rid of that debt before you start considering investing. It's really important to consider, if I have a client that has $100,000 in their checking account, and we see that quite often, but then they've got, $40,000 in credit card bills at 22%. Well, does it make sense to leave your money in a checking or money market account at 0.1% while you're paying 22% on the other side? Sometimes, people, even though they want that cushion, sometimes you've got to get rid of that debt. It's not just about looking at your checking account being huge. It's about being smart overall.
Absolutely. So the importance to know obviously would be good debt versus bad debt. So good debt would be what, like a person's mortgage?
Sometimes. So now with the higher standard deduction, sometimes mortgages don't make sense if you have the assets to pay it off.
Okay.
It all depends. You know, with a $24,000 standard deduction for couples, does it make sense to have a mortgage if you can't deduct it anymore, if you don't itemize?
Okay.
That's a huge question to ask. For some people that have a mortgage, you know, it's out of necessity. You know, they don't have the cash to pay off their house, which is, you know, very common, of course. But for people that do, you just want to weigh all of those factors of whether or not it makes sense to pay it off. And that brings us back to that tax conversation. You have to look at the whole picture. And I think oftentimes advisors are so focused on the investments that they miss the bigger picture, the taxes, you know, the expenses that are being paid out in mortgages, for example, the debt, because, you know, a lot of people try to do the least amount of work necessary to get paid.
Yeah.
And that's what we see quite common in the industry. And, you know, we're just hoping to change that you know, whole mentality with asset preservation.
Absolutely. And Stewart, do you ever recommend that people test drive their retirement, if you will? Do you have them put maybe a spending plan in place for 1 year and see how that works for them?
Well, so what we do is we can actually model that on our computer system. We have some of the best cash flow modeling available. So we can model out those scenarios where people, you know, say, hey, you know, I'm going to retire, but my daughter's getting married. And we can add all those scenarios into your life plan, and we can simulate all of that ahead of time. But you want to know the answer before you retire, because it's a lot harder to, you know, go back to work at 66 than it is to stay working at 62.
Sure. And is that still the number 1 fear, Stewart, that a lot of people have, is that they're going to run out of money during retirement?
Absolutely.
Yeah.
You know, the worst thing that I can say is, and I know it sounds counterintuitive, but for a person at the end of their life to look back at their $2 million that they've saved and not having done what they wanted to do during their lifetime.
Yeah.
Savings is about enjoying yourself,
Yeah.
right? It's about creating an environment where you can just squeeze all of the nectar out of life and enjoy the heck out of it, but do it comfortably, knowing that you're not going to be broke later on.
Definitely, because you've worked your whole life to enjoy those years. And now, it used to be when you thought about people retired, they just kind of sat on their front porch with lemonade, but not anymore.
Right.
They're traveling, they're enjoying their time together.
Exactly.
So Stuart, we only have about 30 seconds left in the show. Can you once again tell the viewing audience what they can expect to receive by being one of your first 10 callers this week?
Sure. Well, I think we're already up to 10, so I'll expand it to 15. But what I'll tell you is if you call the number at 1-833-652-7829, I will do that complete analysis, that Morningstar analysis, where we'll take a look at all of the risks, expenses, etc. in the portfolio to let you know where you stand.
Stewart, thank you. To the viewing audience at home, thank you so much again for watching this week. We look forward to spending time with you, same place next week. We'll see you soon.